For more on this blowout quarter, let's bring in Mary Jane Matz. She is Director of Large Cap Value Strategies at Fifth Third Asset Management in Cleveland. JPMorgan is one of the top holdings of Mary Jane's Large Cap Value Fund. Mary Jane, thank you very much for being with us. What's your first cut on the numbers?
Well, yeah, obviously, well above consensus, but I'm not sure that the headline number is as important to investors as the outlook statement. And I guess if there's any, room for disappointment here, it's that we didn't get any indication on the dividend, which I think is probably, politically a wise move on their part to be mum about that. They certainly have the capacity to increase that, but that is not mentioned here. In addition, the outlook statement, isn't any different from what they said at the end of the fourth quarter. So I think if you're seeing a muted reaction in the stock, maybe that ties out to the lack of those kinds of comments.
Mary Jane, is Jamie Dimon being a little too conservative here, even though credit loss provisions are down to $7 billion in the quarter? In the retail business, net charge-offs are down, non-performing assets are stable, and delinquency rates are dropping on mortgages and home equity. In the card business, net charge-offs are up, but delinquency rates are down both on 30-day and 90-day plus basis.
Yeah, you got it. Those are clear signals that we have passed the bottom in terms of the consumer credit cycle here. But there are still a lot of unknowns, particularly on the regulatory front. And I think at this point, keeping excess capital, keeping powder dry is the prudent strategy.
Mary Jane, you mentioned how we might have passed the bottom in the consumer cycle. Our earlier guest, Michael Holland, talked about the losses in the credit and retail division, saying that improvement there will be glacial. What's your take on it?
Yeah, I think we're probably going to be surprised on that a lot of the excess was wrung out of those markets relatively quickly this time through. The banks have very aggressively tried to address non-performers and have aggressively added to reserves. So I think, if anything, there's a surprise baking there that the improvement is going to come much quicker than expected. And
when could we see that surprise unfold?
Well, I think you're seeing it right here in these numbers in the next, say 6 months. I think we'll be clearly moved from the recovery mode in the economy to an expansion mode, and that's a very different mentality, very different philosophy is going to take hold here. Our concern will start to be inflation.
Mary Jane, Jamie Dimon is often held out as the golden boy of Wall Street and held in contrast to Lloyd Blankfein of Goldman Sachs. But as of late, he has been on the record complaining about the criticism that banks have faced. Is he putting JPMorgan at risk by talking so tough?
No, I don't think so. He has achieved kind of a rock star status. I think it is, well deserved. This firm really stepped up in the crisis with the purchase of Bear Stearns and WAMU, and I think what you're seeing there is some frustration that there are not yet clear rules in terms of what the banks are going to need to hold in terms of capital. They're right now building up excess capital that will be a growth engine, as Jamie Dimon said on last quarter's conference call, for future growth. But we're well past the trough of this cycle, and it's time for banks to be unleashed here.
Mary Jane, thanks very much. That's Mary Jane Matz of Fifth Third Asset Management.